Hello everyone. In this part, we're going to continue our discussion about accounting, and we're going to focus on the financial statements. But before we go there, I just want to clarify that stockholders' equity is classified into two parts. We have the common stock, which is basically what the owners or the shareholders contributed to the business. And then the second part is retained earnings, which is the amount that's been retained within the business from the company's profits. So let's try to see more about that. So, according to the book, common stock is shares of ownership distributed to investors of a corporation. It represents the portion of stockholders' equity contributed by investors. On the other side, we have retained earnings, which is the stockholders' equity created from business operations through revenues and expense transactions. So, from its name, I think it's easy to remember. Retained earnings is the amount of earnings that the business decided to retain or keep in the business for future use, but typically for future growth. So stockholders' equity created by investment by stockholders, which we call it common stock, and by business operations, which is retained earnings, are reported separately. We don't really combine them together. We like to separate them in the financial statements. In this chart here, you can see that we have the types of transactions, and you can see that stockholders' investment, represented by common stock, is one of those things that increases stockholders' equity, and this is why we have this plus sign. Distribution of earnings to stockholders, which we call them dividends, they are the things that reduces the stockholders' equity. On the other side, we have revenues and expenses. Revenues are good news, and they usually increases your stockholders' equity. And this is why we have the plus sign. Expenses, these are the bad news. So these are the things that are going to reduce our stockholders' equity, and this is why we have a negative sign. Revenues and expenses, when we combine them together, this is what we call it net income. So if revenues are more than expenses, we end up having a positive net income. If revenues are less than expenses, in other words, we have expenses that exceed the amount of revenues we earned, in this case we'll have a net loss, or what we call it negative net income, which are typically referred to as net loss. Here we're going to have a checkup corner. I'll leave that for you to go over and work on yourself, and I think it's just a basic application of what we covered. So now let's talk about the financial statements. So after transactions have been recorded and summarized, reports are prepared for users. The accounting reports providing this information are called financial statements. In this textbook, we're going to learn the four basic financial statements, which are income statement, retained earnings statements, balance sheet, and statement of cash flows. There's another statement called the statement of changes in stockholders' equity. In this class, I'm not going to focus too much on it. I'm only going to focus on these four statements, which is again the income statement, statement of retained earnings, or sometimes we call it retained earnings statements, the balance sheet, and the statement of cash flows. I'm going to focus mainly on the first three, and the statement of cash flows would be our last focus in the very last chapter. So the order is also very important. I want you to make sure that you know that we have to start with the income statement, then we prepare the retained earnings statements, and then finally the balance sheet. We cannot go in reverse order. So I'll give you the reason why we have that. So what is the income statement? It's a summary of the revenue and expense of a specific or for a specific period of time, such as a month or a year. So basically, the income statement compares revenues and expenses, and that's it. Retained earnings statements, it's a summary of the changes in retained earnings that have occurred during a specific period of time, such as a month or a year. So in other words, the statement of retained earnings is a statement that shows how much retained earnings changed. There are things that increase retained earnings, like revenues, or in other words, your net income. And there are things that decreases retained earnings, which are things like dividends. Then we have the balance sheet. And this is a list of the assets, liabilities, and stockholders' equity as of a specific date, usually at the close of the last day of a month or a year. The balance sheet is different from the income statement and the retained earnings statement. The balance sheet is more like a snapshot. It's like a photograph that shows a specific period of time. The income statement and retained earnings is like a video because it shows the performance of the business over a period of time. Another thing I want you to remember, the balance sheet shows or represents the accounting equation. So we have the assets, liabilities, and equity. The income statement on the other side only focuses on revenues and expenses. One of the last statements that we'll be covering in the very last chapter is the statement of cash flows. And it's a summary of the cash receipts and cash payments for a specific period of time, again, such as a month or a year. So the statement of cash flows does not focus on revenues and expenses. It only focuses on cash collections and cash payments. So this chart here just shows you that the order that we have to go through. We have to start with the income statement. Once we have the income statement, we reach the last value, which is the net income. And we use the net income to prepare the statement of retained earnings. And then the balance of retained earnings is used in the balance sheet under the equity section. And then finally, we have the statement of cash flows, which confirms the value of the cash on the balance sheet. So this is the sequence that we have to go through. We have to start with the income statement. Then we prepare retained earnings statement. Then we have the balance sheet. And then finally, the statement of cash flows. So one more time, what is the income statement? The income statement reports the revenues and expenses for a period of time based on the revenues and expenses recognition principle, not based on cash received and cash paid. These principles match revenues and their related expenses so that they are reported in the same period. The excess of the revenue over the expense is called net income. Sometimes we refer to it as net profit or simply earnings. If expenses exceed revenue, then in this case we call it net loss, because in that case we will have a negative net profit or net income, and we typically call that net loss. So what about the retained earnings statement? The retained earnings statement reports the changes in the retained earnings for a period of time. It's prepared after the income statement because the net income or the net loss from the period must be reported in this statement. In other words, in order to prepare the retained earnings statement, we need to get the bottom line number, which is the net income, from the income statement to prepare the retained earnings statement. Similarly, it's prepared before the balance sheet, since the amount of retained earnings at the end of the period must be reported on the balance sheet. Now let's see the balance sheet. So the balance sheet reports the amounts of assets, liabilities, and stockholders' equity as of a specific date. The report form represents the balance sheet in a vertical form. So we usually start with assets, then we show the liabilities, and then the equity. There's also another form of the balance sheet, which we call it the vertical form, where we show the assets on the left-hand side, liabilities and equity on the right-hand side. But again, most companies nowadays, they use the vertical form. The statement of cash flows, which is the last statement, we're not going to talk too much about it, but we're going to stress much more on it in the very last chapter. And it consists of three sections. We have the operating section, we have the investing section, and then we have the financing section. So this is the only thing I really want you to know about the statement of cash flows at this point. That it consists of three parts. We have the operating activities, we have the investing activities, and we have the financing activities. The cash flows from operating activities section report a summary of cash receipts and cash payments from operations. On the other side, cash flows from investing activities, these are reports that cash transactions for the acquisition and the sales of relatively permanent assets. And that's what we call it investing. And then finally, financing, the cash flow from financing activities section reports the cash transactions received to cash investments by stockholders, borrowings, and dividends. So this chart again shows the interrelationship between the main three financial statements, which is the income statement, the retained earnings, and the balance sheet. And of course, at the very end, we also have the statement of cash flows. And it just gives us an explanation of how they are interrelated. And as I mentioned before, we have to start with the income statement to get the net income. Once we have the net income, we can prepare the statement of retained earnings. And once we have the ending balance of retained earnings, we use it to prepare the balance sheet. And then the last thing, we prepare the statement of cash flows to confirm the value of cash in the balance sheet. Again, I'll let you apply this kind of exercise as a way of practicing this concept. The last thing in this chapter is to do some kind of analysis for decision making. And we are going to be covering that in every single chapter towards the end. We're going to see some kind of ratio analysis that can help us analyze the financial statements and the financial records and see how the company is performing. So one of those ratios that we're going to be learning today is the ratio of liabilities to stockholders' equity. Liabilities and stockholders' equity, these are two values that you can find on the balance sheet. So in order to run this ratio, you need to have a balance sheet. Because remember, the balance sheet focuses on the accounting equation elements, which are the assets, liabilities, and equity. And in this ratio, we're only comparing liabilities to stockholders' equity. So the ratio of liabilities to stockholders' equity is useful in analyzing the ability of a company to pay its creditors. The ratio of liabilities to stockholders' equity is computed as follows. We have total liabilities divided by total stockholders' equity. Let's see our example here and try to apply the ratio based on the information we have in the examples we used. So net solutions ratio of liabilities to stockholders' equity at the end of November is computed as follows. We have $400 for liabilities and $26,000 and $50 for stockholders' equity. By rounding the value, this is about 1.5% or 0.015. So what does that mean? The lower the ratio of liabilities to stockholders' equity, the better able the company is to withstand poor business conditions and to pay its obligation to creditors. Very similar to any individual. If we have a lot of liabilities, that creates a lot of commitment. The lower the ratio, the lower the commitment that you have compared to your equity. So since the total liabilities are only 1.5% of the total stockholders' equity, net solution is in a solid position to pay its creditors because it's a very small percentage. So by that, I conclude chapter 1. Thank you for listening. I wish you all best of luck. Please let me know if you have any questions. Feel free to email me, and I'll be there to answer any questions you have.